Thanks so much for tuning in to Talking Point. It's a special one. It's the first one of the new year, and it's the first one post what a lot of people would say wretched 2020. But for equity markets, it was actually not that bad a year. It was almost as if COVID never happened. The question is, after such a fabulous um, last 6 months, and especially the last couple of months, where we rallied close to 20% maybe. The question mark only is, what do we do from here? Well, let's ask somebody who eats, sleeps, breathes equities for a living, Harshad Patwardhan of Edelweiss AMC Johnson, right now to talk about his thoughts. Harshad, good having you. Thanks for joining in. Hope all is safe.
Yes, Niraj, thanks for having me, and wish you and all your viewers a happy new year.
To you and all your investors and office members too, a very happy new year. You reckon it'll be a happy new year, Harshad? I mean, we're on the throes of a vaccine earnings season, Q3 after the Q2 surprise. We have a budget, a slew of IPOs. Are the decks set for a positive year?
Yeah, I mean, after, as you said, 2020, the kind of year it was, I think 2021 will be a year of normalization, moving towards normalization. And you're right in saying that the markets have done very well from the bottom, third, fourth week of March. But if you look at calendar year as a whole, I was just checking that in the morning, it has returned to probably 15-16% in line with the average. And if you look at, as you always should, in equities over the last 3, 5, 10 years, the returns actually have been lower than the long-term trading average. I would argue that the condition is right now for the returns over the medium term to be higher than the long-term average.
Okay. So, no, sorry, are you saying that 2021, we might actually see returns which are higher than the long-term trading averages, kind of making up for 2020?
No, I'm not just specifically saying about this year itself.
Oh.
If you look at a block of next few years, so for example, if you look at, as I was saying, last 3, 5, 10 years, the returns have been barely 10, 11%, right? And as you know, the long-term average is about 60-odd%. I would say that because of the conditions that are coming together, happy conditions that are coming together, over the medium term, the returns are likely to be higher than that.
Okay. So, okay, let me try and put it this way. We have a decent cocktail of lower interest rates, liquidity, and possible earnings momentum from the low bases for 2021. Even if you take a 5-year block, Harshad, of your thesis of how returns might be slightly higher than the averages, do you reckon that in this 5-year block as well, returns could well be front-ended because of the conditions that we spoke about, or is it difficult to kind of call that?
I would say that mid-cap and small-cap is where the returns are likely to be front-ended. If you look at the history, analyze history over the last 25 odd years, in that segment the returns tend to be front-ended. And you referred to some of the very important conditions prevalent, which are favorable for markets to do well. But I would say the most important one is that the economy has finally bottomed out. People talk a lot about second quarter of last calendar year when the economy shrank by 24-25%. But what many people tend to forget is over the last 4 years, economy actually has been decelerating. There have been many India-specific problems, as you know, right from demonetization to GST to the ILFS, NBFC crisis and so on. So there has been a deceleration that's happening for quite some time in India. And if you look at over a 10-year period, there has been a very stark deceleration, from the growth rates of 8.5-9% that we witnessed more than a decade ago. And that is bound to be reflected, and as it is, in the earnings growth of corporate India. So if you look at Nifty as a proxy, over the last 6-7 years, earnings growth has been barely 2%. If you look at 10 years also, it is probably mid-single digit. But what we see happening now is that the economy bottoming out and the favorable macro conditions that you described in terms of liquidity being abundant everywhere, and also interest rates being lower, and more importantly, the government being very focused on inducing growth. I would say that we will see growth acceleration in the economy, of course, helped by the slow base, but more importantly, corporate earnings growth is also likely to smartly recover. If you looked at last quarter's numbers for corporate India, they have surprised on the positive. And I have actually seen earning upgrades. And that is something, Niraj, I must confess that I'm seeing this after a very, very long time. So I think all that will come together. Yeah.
Would there be a factor of the street just underestimating the prowess of India? I mean, your company as well would have done belt lightning, and Edelweiss as an entity would have done belt lightning. The analyst community just didn't factor in the extent to which India Inc. could perform well, and maybe the surprises might not come. We might have earnings growth, but it will not be a surprise because now the street will factor in that India Inc. could do something special when put in a corner.
So you are right in terms of cost containment. I think it was astonishing the extent of fixed cost and variable cost containment that Indian corporates have done. And I must, give a sort of a qualifier here that when I'm referring to the strong earnings, I'm referring to a very narrow part of the corporate India, which is the listed companies, which by definition are better organized. I know that there is a lot of pain in the SME side. We should not underestimate that. So you're right that there is a surprise. There was a surprise, and to that extent, there will be less of a surprise going forward. But if you looked at, and frankly, Niraj, I was also on sell side for 12 years. I was an analyst covering various sectors, and as an analyst community, they tend to be very, very conservative. So they look at an additional data. So on the way down and on the way up, you will see earning downgrades on the way down and earning upgrades. So as more and more evidence becomes available, I think analysts will, I'm not just referring to the cost containment, but the buoyancy, the operating leverage in the system. I would argue that there will be a slew of earning upgrades that will continue.
I know. So by the way, I'm not blaming the analyst community out here. There are rules and processes. I know a lot of people go about, lambasting the sell side for mistakes that they make, but I think there are processes to be followed, and a lot of people don't understand that. So I'm not getting into that at all. I'm just broadly saying that maybe all of us, it took everybody by surprise, right? So maybe all of us put together underestimated India Inc. and India Inc. outperformed compared to those estimates. But nevertheless, so let's assume that earnings surprises and earnings growth is probably here to stay and might hopefully accelerate as time comes. What about the factor which is not in the hands of India Inc., which is what the government can do now with the slew of duties that have been levied, the measures like PLI schemes, etc. It shows that the government is conscious that there needs to be intent. Do you think that the budget, quite unlike the previous few, wherein the market said that the budget need not be a market-moving event, and it's good if it's not, do you reckon that this time the budget needs to be a market-moving event, or things can be done beyond the budget? And the budget, it's okay if the budget is a not.
Yeah. So Niraj, from the time that I started, caring about the budget when I joined this industry on the sell side, budget used to be the most important day for the economy and the markets in a year. Clearly, as you alluded yourself, that the salience of the budget has diminished because, frankly, policies can be announced around the year. In addition to that, we have seen that the indirect taxation is pretty much out of the budget now. GST, etc., that's separate. Also, government last year made very important changes to corporate taxation, as we know. It looks like a long time back, but it was probably 12, 15 months back. So I don't expect too much from a taxation perspective. Although I have one hope and expectation from the budget, which is in 2020, through all this crisis, especially compared to what many other economies did, I think Indian government was, very, very muted in terms of the fiscal stimulus support. And we know why. That frankly, there was not a lot of dry powder available, the debt levels are high, etc., etc. The indications that are now coming out is that it's possible that within limits, we are never going to have the fiscal stimulus like what they had in US or in Europe. But within limits, I think we might be surprised on the positive by some kind of a moderate fiscal stimulus. So that is something that I'm very eager to see what the government does. Because many government officials have said that we will give fiscal stimulus when the economy starts coming out of the problem. And now that there is evidence that the economy is indeed bouncing back nicely, I think if the government were to give a bit of a nudge, that will be helpful.
Yeah, well, I think there's a Bloomberg story 3 days or 4 days ago, which is speaking about this possibility happening. Okay. It's there on our website too, by the way, about how there are indications that things may be a bit more than what is anticipated. Okay. So earnings in place, maybe the government through the budget or beyond the budget keeps on doing what it is doing. Um, one factor that might go counter. The only question is whether the market will be perturbed by it or not. Is inflation coming back? Now, world over, there's this talk. We just put out, or we will put out a story today, which is looking at all the global think tanks and what are they saying about various key factors. One of them is inflation, wherein almost everybody believes that inflation will come back, but rates won't budge because central banks have committed to that.
Yes.
What about India, Harshad? If indeed rates do come back, could the RBI be in a bind, or do you reckon that the low interest rate regime in India too would continue, irrespective of inflation moving up a little bit?
So, as you alluded to, there has been a fundamental change in the policy, which has been articulated by the Fed, where, as you know, they went from saying that instead of spot level 2%, we will look at the average. And that, I think, is something that probably they speak for the monetary policy makers world over. So I don't think that in India also, the RBI is going to be very active in looking to increase the rates. All the indications they have given so far, both from monetary authorities, RBI and government, is that they are completely focused on inducing growth in the economy. So at least in the near to medium term, I don't see that as a big risk. Maybe the rates will not go down further, but any aggressive rate increase is unlikely. I'm an equity person, but the way I look at it, it's very unlikely if you look at the global backdrop itself.
Got it. So, in light of this, then, Harshad, where is it that you guys at Edelweiss AMC, as a house largely, I'm not talking about scheme specific, but as a house, are placing bets within equities? I mean, there is a whole bunch which believes value will come back. There is a whole bunch which believes that, yes, value, but within that, sectors which are showing sharp growth. So, don't go for buying low PE, go for buying moderate PE with better growth potential. And there is a bunch which is saying, no, we want to stick to the tried and tested because in these testing times, these are the ones which will do well. Where are you more overweight on, if I can ask that question?
Sure. So, value and growth is an eternal debate in our industry. So let me put it slightly differently. So given our worldview that Indian economy has bottomed out, corporate sector is likely to do well, and so on, incrementally, if you looked at our fact sheet 3 months ago versus now, you will notice that we are moving more towards the cyclical place. Within the way we define it, we call it strategic tactical. So tactical are the ones which are more leveraged to the economy doing well. So sectorally, for example, if I have to give you 2 examples, we are more positive on banking and financial services compared to what we were 6 months ago. Similarly, industrials as a space, capital goods, I mean, it's a big space. We are more positive than we were 6 months ago because we believe that these are the sectors which are more levered to the economy. BFSI is an interesting example because when the lockdowns happened and the economy shrank, clearly BFSI was a problematic sector given the inherent leverage in that business. However, as you have seen in results and more importantly in the commentary that has come from the CEOs of many of these, is that situation on the NPL front is expected to be far better than what was feared in the darkest days of the crisis. So BFSI and industrial are the 2 sectors where we have incrementally gotten positive.
RBI commentary doesn't deter you that because of this moratorium, the numbers have been masked and they might come out as a nasty surprise.
So that is something that analysts have, I think, already factored in.
Okay. So you are saying that you believe that BFSI has the potential to outperform a lot of other spaces. I'm just trying to understand whether you also kind of believing in benchmarking your fund performance to the larger benchmarks, and therefore you would moti want your weightages in BFSI to be in and around the weightages in the Nifty, or you guys are not managing your funds that way?
No, we are, the way we manage the funds we are not benchmark hugging, but we are benchmark aware. So, it's a very important sector, as you know, in our indices, particularly large and mid and multi-cap, almost a third of the benchmark is BFSI. So that is something that you have to get right. So we were underweight in the, immediately after the crisis because we didn't know, frankly, right? Everybody was, and this is a sector that is very sensitive to the economy. So we have gradually become neutral to overweight in that particular sector.
Yeah, sorry, a bit of a power outage, but nevertheless, so so BFSI, you seem to be believing that you are confident, and you keeping in mind that you are aware of the averages. So let me ask you a follow up. Where is it? And last couple of questions. Where is it that compared to benchmarks, you are much more overweight on or largely underweight on, which is a contrast to what the weightage of that sector or the theme in benchmarks would be?
Understood. So we would be most overweight on industrial as a sector. I think this is a sector within industrial, you will have construction, capital goods, whole lot of companies. So that is one sector that we are very, very hopeful of. That if the economic growth, story plays out the way we expect it to be, I think it's a matter of time when corporate capex will come back, which has been lacking for a long, long time now. So industrials is where we are most positive on. And I think the traditional defensive sectors, FMCG, domestic pharma, are the ones where we are most underweight.
Okay. Is the call on FMCG because of the valuations that these sectors, that this space has? And can I chip in with not just staples, but some of the other discretionaries? I mean, if I can call paints, for example, discretionary, because the problem is every time you think that, for example, in Asian, I mean, I'm not asking you to comment on companies, but I'm just using them as illustrations. That every time you think that Asian paints is very expensive, or some of the other staples are expensive, they go out and surprise you with the performance, and then the market rewards them even more.
Correct. So we always think on relative terms, Niraj, because ours are relative return performance funds, right? The reason why we are relatively underweight on FMCG and domestic pharma is not that we don't like these businesses, but it's just that we think that in a market which will be more cyclically driven, more economically sensitive businesses, they are likely to underperform. So absolute valuation, there is, we never buy something because it appears expensive. We never sell something because it appears expensive, or buy something just because it appears cheap. You have to see it in the context of where we are in the economic cycle and earning cycle.
Since you mentioned mid caps, couple of sectors, Harshad, where I want to know if you guys are bullish on. One of them is a sector which has actually performed really well in the last few years, and that's specialty chemicals. Even the largest companies, maybe not very much a large cap, 20,000-30,000 crores. So you could call it a large mid cap or large cap, let's assume that way. But a large portion of them, world leaders in their own right, but are mid caps. What do you feel about that? And then I would want you to comment on real estate, because that seems to be coming out of the darkness, so to speak.
No, I should have mentioned of real estate. So let me start with real estate. So real estate is one more sector. If you look at our fact sheets, we were pretty much not there till about, I would say, 6 months ago. Because real estate sector, as you know, has gone through very tough times over the last few years. Apart from what I mentioned already, RERA was another thing, right? But we have definitely seen green shoots in real estate for the past few months now. And another interesting thing that is happening across sectors, but probably most spectacularly in real estate, is more organized nature of the business. So many tier 2, tier 3, tier 4 developers are going out of the business, and the hands of the organized listed players are actually strengthening. So that is something that we are witnessing quite a bit. And that's one more sector where we are incrementally positive on. Coming to chemicals, Niraj, we have been playing chemical story for the last, I would say, 4 years or so. You might recall that it started with the Chinese government getting very tough on the pollution control measures, etc. However, this is a story that continues to remain strong because the latest trigger for this is this whole strategy of global corporates of China plus one on the supply side. And because of last year, the COVID crisis, I think that has become even more strengthened. So globally, I think in boardrooms, every director is asking the CEO, what is your, supply strategy? How will you reduce dependence on China? I think Indian companies, and as you rightly mentioned, that some of the leading companies in individual products in specialty chemicals, many of them are Indian companies. And those Indian companies are benefiting. Many global corporates are approaching them for 10-year, 5-year kind of long-term contracts, also willing to give them some money upfront. So I think this story continues to be very, very strong. And if you look at our portfolios for quite some time, they are overweight on this theme.
Well, lovely talking to you today, Harshad. Thank you so much for being with us on Talking Point, and to you and yours, have a fabulous 2021.
Thank you, Niraj. Thanks for having me.
Pleasure is ours.
Bye.
And viewers, thanks for tuning into this edition of the Talking Point.